Hello, this is Abhishek Garg, and I welcome you to yet another video series from the TheCapitalNet TV. In this video, we will deep dive into one of the specific areas of venture financing, that's venture debt, or also called debt financing. With us today is Mr. Tony Huang, who has been part of the global private equity VC industry across Silicon Valley and Asia Pacific since 1995, playing multiple roles of an investment professional, angel investor, and business advisor. Prior to co-founding KISO Capital, Tony was a venture partner at WI Hypo, vice president at NXT Capital, and director of international venture capital at the Silicon Valley Bank. So, what are the kind of venture debt options available to a founder today?
A typical venture debt is a term loan, right? Meaning you take the money up front and you pay it back over time, typically 3 to 4 years, right? It's not unheard of. Probably the longest term I've heard is about 5 years, but that's for a much later stage company, obviously unicorn and a lot of enterprise value relative to the amount of debt dollar that's being deployed, and or they have raised tons of capital, right? Typically, if you think about a biotech firm or a pharma firm, when they raise equity, that's represent at least 5 years of cash burn, right? So venture lender that can do the math, they figure, okay, my money gets repaid within 3 to 4 years, and this company has enough cash to last another 5 years, so I'm safe in that sense. So a typical term is 3 to 4 years, but it's amortizing term loan, meaning you pay back interest and part of the principal every month until the loan is fully repaid, right? So that is a typical structure. But in the recent years, because of cloud computing, because of SaaS, both enterprise as well as B2C, these companies have a subscription-based revenue, right, which is recurring in nature. So, but they don't have much in the way of receivables or on-balance sheet assets that they can monetize or put up as a collateral. So MRR lending, or monthly recurring revenue lending, has become increasingly popular nowadays. And that's basically for, mostly for enterprise SaaS companies, software as a service, where you can probably the metric, it varies from depending on the type of lenders. Again, risk appetite. A commercial bank that does MRR lending probably top out at about 3 to 4x of your MRR, right? So whatever is your monthly MRR, you can borrow up to 3 to 4x of that amount. They'll lend it to you, okay? And so you can take that money up front to reinvest in the business. Whereas a pure venture debt player, that's like a debt fund or a public traded BDC, for the right company, you're probably looking at closer to 10x of your MRR, sometimes even more. Right? If you're backed by tier 1 VCs, good track record, reputable entrepreneur, etc. So that's MRR lending, right? So that's another form. And in recent years, it's similar to the MRR lending. You also have basically these are revenue-based financing, right? MRR lending is a revenue financing, but for a lot of e-commerce companies, right? They have a lot of transactions, and there's data insight that can be obtained from these. A lot of these are, repeat customers, right? They can calculate, for important metric for these companies are cost of customer acquisition, right? Or customer acquisition cost, CAC, or LTV, lifetime value of the customer. So all that metric in terms of your sales volume, your churn rate, your customer return rate, all that, there a lot of lenders out there that figure out a formula where they can lend off your trailing revenue. Okay, whatever revenue you have achieved in the past, they can figure out a formula to and use that as a basis to provide capital to you instead of using your on-balance sheet asset, on which if you're an e-commerce company, the receivable turns into cash very fast, right? Especially if people pay by credit card or PayPal, etc. There isn't really a receivable on your balance sheet that gets turned into cash, 60 to 90 days from now, right? That's traditional bank financing. They look for those type of assets, financeable assets. But e-commerce companies, e-tailers, they don't have that. But in lieu of that, they have historical sales transactions, and that could be a basis of to obtain a loan. So that's another form of venture lending. So that's in general is in a nutshell, just several broad categories of venture debt that exists in today's market.
Okay. So what kind of growth-oriented companies generally avail venture debt, like blue chip, SMBs, tech companies, and how does it help them?
When you mentioned blue chip or S&P, we're not talking for venture debt. We're really talking about privately held companies that are not public traded, right? So it could be from bootstrap all the way up to unicorn status company, right? So there's 700 unicorns that exist today globally, right? What type of company? It actually runs the whole gamut of different type of industries, right? But venture lender look for certain things, and they look for revenue traction. They look for good institutional VC support, right? If you think about it, if you're lending to one extreme, let's take the extreme of a pre-revenue company still in development stage. They're developing a product or a service. It's going to take tens of millions or hundreds of millions of investment until they can have a product and they can sell to the customer to generate revenue. Before you reach that point, you're still burning cash. Okay. Now, venture lender can complement equity capital and provide some of the capital along the way. Okay, but not all of it. Okay. So venture equity still has to take majority of the risk. Okay, but you can take venture debt and it complements the equity and it minimizes your dilution. Okay. So these companies that we look for are typically, capital efficient. There are some people that would do it on lend to pre-revenue companies, and they absolutely need to be backed by, institutional VCs, right? Lending money to a pre-revenue startup that's not backed by institutional venture equity, it would be essentially stepping in the shoes of venture equity, right? Then it's not called venture debt anymore, right? And if you're not getting the right economics, because you don't have the same percentage ownership the VCs do, so that doesn't make sense. If you're taking debt risk but generate equity-like return, right, of which you can do the Google search and see what the historical venture equity return is like. It's north of 20%, closer to 30%, right, across 10, 20, 30-year sort of a time horizon. But the type of companies that borrow, it varies, right? So some are venture-backed, some are not. So the way KISO likes to, and maybe I'm getting ahead of myself, but our model is a little bit different from other venture lenders. Majority of the venture lender, the 50 or so that I mentioned, they almost all of them require the company that they lend money to be backed by an institutional VC fund, typical Sand Hill Road crowd, or it doesn't have to be Sand Hill, but institutional VC, right? Meaning it's not just friends and family or some seed fund or some family office, because they're counting on the company's ability to raise the next round of equity, and that's their repayment source, right? Because the company isn't self-sufficient yet. They need to raise subsequent round of equity, Series B, Series C, etc., in order to have enough cash to pay back the venture debt. Whereas KISO Capital, the firm I work for, that I started with two other partners, we realized that, in reality, less than 1% of all startups are venture-backed, meaning more than 99% of all startups, not just tech, right? Just I'm talking about all startups in general, more than 99% are not venture-backed. Okay, plenty of companies are very successful and reach successful exit with just the founder's money or bootstrap. Okay, they never raise institutional VC money, maybe because the industry that they're in is not particularly high growth, but these are good companies, solid companies, what we like to call real businesses, right? They're not developing, it's not bleeding edge. They're not developing the bleeding edge technology that may or may not have a market. So we look for companies that, either develop a product or a service, it doesn't matter. Our first portfolio is actually a winemaker, red wine. They produce red wine, but it's a great business, growing and profitable. and they don't want to deal with the bureaucracy of a commercial bank, so they pay us, what others would consider an extremely high interest rate, but we think it's the adequate amount for the risk, right? It's definitely north of 10%, but that's the cost of capital to them that we provide. But it's from an experienced entrepreneur, growing business, nearing profitability, and we are providing them with unrestricted slug of capital that they can use to continue to grow their business and increase their enterprise value, hopefully by more than what they're paying us, right? What is the business? Who are you selling to? And is there a product market fit? Meaning, are there people willing to pay you money for your product or service? Yes, you may be just still early, right? I don't have a huge sample of potential customers, but I have a pipeline. And if I'm convinced that there is that path to commercialization and a path to profitability. Most of the companies that we lend to are not profitable. But I can see that they are on the path to profitability. Then that's sort of what we look for. But it's all sorts of different industry, and that's why I like my job, because we get to see companies of all different sizes and in different industries. So fun to learn about their business.